Hello everybody, it's Tortoise Investing coming at you today with another one. If you are new, join the 234 people that have already done so. Hit that subscribe button. I would greatly appreciate it. Let's keep growing this baby up to 300 and then keep on keeping on. If you're returning, or if you haven't yet, hit that like and that comment button. Go ahead and say anything. It can be anything. You say hi. You can let me know what viewer you are, what you've been buying, literally anything and everything, all comments, all likes, stuff like that. It really does help the video out a lot, and yeah, I greatly appreciate it. Super free, super easy to do. So today's video, 5 more dividend stocks you can buy and hold forever. Now let's go ahead and take a gander at these. Some of these I feel are on pretty good sale. If you came just for that, let me just go ahead and run through the list real quick. Got Costco, Dollar General. We got automatic data processing, air products, and chemicals, and Prolongus. Now, if you came for just the list, thank you. Have a great evening. Now, if you came and you want to stay for a little bit of analysis, let's go ahead and jump into this. Costco. Dividend yield 0.73%. Payout ratio is 26.45%. In my eyes, I did a video on this. It's what I think is almost a perfect company. It's just a stair step of revenue, of EBITDA, of net income, of EPS, more cash than debt on hand, dividends rising very quickly. The only thing that I could knock it is it's got a little bit of share appreciation, like depreciation. Their share count's barely going up a little bit over time because of the stock-based compensation, but it's not an issue, I don't think. The return on capital employed, usually above 20%, easy. Yeah, it's an amazing holding. I think, personally, not a financial advisor, anything under 500 is great for Costco. Now take a look at the dividend history. Got 18 years of dividend growth over the last 5 years. We got 12.35% dividend growth average. Pretty good. Next up, got Dollar General. Dollar General coming in at a 1.11% dividend yield, 20.60 payout ratio. It is down a bit. It's the reason I like where it's at right now. It was around the 240s area, and it's dropped about 14%, so I do feel like this is a pretty good entry opportunity. So again, it's a very similar thing with Costco. Got revenue, EBITDA, net income, everything in the right direction. They've had a tough year and a half because they've got a lot of legality things going on with their workers, and they're blocking fire exits and stuff. So their EPS went down just a little bit, but I am more than confident that this company is going to get everything back on track. Everything's going to get right back to ticking. They make their profit margins are they make too much money, which isn't a bad thing if you're your stockholder. So their debt, they got $5.7 billion in debt. Their EBITDA is $4.505 billion. Not an issue there. Not an issue whatsoever. Very easily covered. I like companies that don't have more than 3 times EBITDA in debt. Now they got this, which is their capital leases. I don't count that. I count this. This is hard, straight to the point debt. Their dividend has been increasing rather quickly, which you want to see. Been buying back shares. They get a return on capital employed of around 15-20% very reliably. Again, very good. Take a look at dividend history. Been growing our dividend over the last 7 years. Over the last 5 years, they've been having a dividend growth average of 16.17%, which is very nice. You don't get raises like that from your job. Not about like a super promotion. Now, next up, automatic data processing. Got dividend yield 2.32%, payout ratio 58%. Got revenue, EBITDA, even a free cash flow, net income, EPS, everything is, again, ticking in the right direction. You like to see it. Again, this one was around 240, very similar to Dollar General, around the 240s. Now it's in the 2 teens. They got some debt. They got $2.99 billion in debt, but their EBITDA completely blows that out of the water. So, again, Debt is not an issue whatsoever. They've been growing that dividend real nicely. They've been doing share buybacks, which is real nice. And they have a return on capital employed of well above 20% since 2013, which is very nice. It's even been above 30% for a while, which is a great holding. I had this at one point, and then I sold it because I had so much SCHD, and this was a good portion of SCHD, and I feel like I needed to double dip it. That's not the case anymore. It's not the case, so I might jump back into it. Been growing our dividend for 48 consecutive years. That's a 5-year dividend growth average of 13.31%, which again, very nice. Everything above 10 makes me happy. Next up, we got Air Products and Chemicals. And they went on a little bit of a run here last little bit. So right in the 320 area in December. So it's came down a good little bit. If you're looking for an entry opportunity, right now might be the time. Got dividend yield 2.45%. Got a nice little revenue, EBITDA, net income, EPS growth, everything again ticking in the right direction. They got $7 billion in debt. Their EBITDA is $4.22 billion. Again, falls right under that. Not greater than 3 times EBITDA. So it's a check from me. Got a nice little history of dividend growth. The only thing is their shares are slowly growing, but it looks like this is something that was accelerating and is slowly slowing down. The return on capital employed is around 10%, so not the best, but not the worst. A very reliable company, I feel. They've been growing their dividend for 42 years. Over the last 5 years, been growing at 11.26% average. Again, very, very nice. Now, for all my REIT lovers, we got Prolongus. Now, at one point, I think this was around the 170s. And she's down to about 119 right now. So, again, I feel it's a very good entry point for these. Got a dividend yield 2.91%. We ain't gonna pay attention, no payout ratio. When it comes to all things REITs, you want to look at the funds from operations, the FFO, and it has a very good FFO. I didn't pull it up, but you can look it up if you want. Just type in Prolongus, FFO, NASDAQ, and you'll be able to find it that way. But revenue, EBITDA, free cash flow, net income, pretty much everything going the way that you want it to go. It's a very reliable company. I do have to say that out of all the REITs, this, Vici, and Agree Realty are probably my favorites. They've been growing their dividend for the last 10 years. Over the last 5 years, they have a dividend growth average of 12.42%. So, yeah, I feel like these are pretty good fit for any portfolio, honestly. If you have any questions about any of them, or any questions whatsoever, just let me know down below. I greatly appreciate everyone who does. And, hope you enjoy that. And until Wednesday, hope everyone takes care. See yous.